If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing.
Buffett never liked gold. He called it a shiny object, a terrible investment. But in today's world, where inflation is high, markets are volatile, and central banks are hoarding gold, has the game changed? You see, Warren Buffett speaks from the perspective of a capitalist with an empire. He has the resources to weather market crashes, recessions, even global turmoil. But here's the thing, his strategy isn't one size fits all. Investing in stocks and businesses works if you have the capital, the patience, and the ability to stomach risk like Buffett does. But let's be real, most people don't. For Buffett, a market crash is an opportunity. For the average investor, it could mean financial ruin. So when Buffett says gold is a bad investment, he's saying it from his world, not necessarily yours. The stock market and any risky investment always has two sides of the coin. On one side, potential growth. On the other, potential collapse. And if you don't have the luxury of waiting decades for a recovery, the game changes. So does Buffett's principle on gold still hold true today? Or is the current financial climate proving him wrong? Stay with me, because by the end of this, you'll be able to decide for yourself. Has gold really been a bad investment? But let's take a look at the numbers. In the early 2000s, gold was trading at just around $300 per ounce. Back then, few saw it as a serious investment. Then came 2008. The global financial crisis shook the markets, banks collapsed, and panic set in. Investors rushed to gold as a safe haven, sending prices soaring to $900 per ounce. By 2011, uncertainty lingered, and gold peaked at nearly $1,900 per ounce, a record high at the time. For the next few years, gold cooled off, but history has a way of repeating itself. Then came the 2020 pandemic. Markets crashed, central banks printed money, and once again, gold surged, hitting $2,000 per ounce. In 2024, with inflation climbing and economic uncertainty growing, gold reached new all-time highs, crossing $2,200 per ounce. And now, in 2025, amidst ongoing geopolitical tensions and market volatility, gold has shattered previous records, surpassing $3,000 per ounce for the first time in history. Was gold really a bad investment? Or has it been the ultimate insurance policy against financial chaos? Let's imagine an investor in the early 2000s. He has no stock market expertise, but his country's government is unstable and the political climate is unpredictable. He's not looking to get rich, just to preserve his savings. He decides to buy gold, purchasing 100 ounces at $300 per ounce, totaling $30,000. Fast forward to today, and that gold investment has appreciated significantly. As of 2025, the price of gold has risen to over $3,000 per ounce, meaning his gold is now worth $300,000. Now let's consider what would have happened if he had invested in the stock market instead. In 2008, the financial crisis caused the stock market to collapse, with the S&P 500 losing nearly 58% of its value from its peak in 2007 to the market's trough in March 2009. In 2011, the European debt crisis caused further market instability, with the S&P 500 losing about 19% from April 2011 to October 2011. In 2020, the pandemic led to another massive crash, with the S&P 500 dropping by about 34% in just 33 days, from February to March. And in 2024, inflation surged, peaking at a 40-year high, around 9 to 10%, causing major market volatility. If our investor had been in the stock market during these periods, He would have faced catastrophic losses, watching his savings dwindle with each crash. While the stock market eventually rebounded, it often took years and many investors couldn't afford to wait for recovery. Now gold. Throughout these crises, gold held its value and even increased during times of turmoil. Gold surged from around $850 per ounce in 2008 to nearly $1,900 per ounce in 2011, and reached a peak of $2,067 per ounce in August 2020 amid the pandemic. By 2024, the price of gold was sitting comfortably at around $2,200 to $2,300 per ounce, with a steady rise amidst inflationary pressures and ongoing economic instability. Over the last 2 decades, gold has provided an average annual return of around 8 to 9%, far outpacing inflation and offering a steady, reliable investment. But here's the key difference. While Warren Buffett, who has immense capital and access to insider knowledge, can afford to weather a market crash and take big risks, most investors don't have that luxury. Buffett can buy stocks and wait for them to recover, knowing he can withstand years of volatility. But for the average investor with limited resources, a market crash isn't just a setback. It's a financial disaster. The stock market might offer growth, but it also carries high risk. Gold, on the other hand, provides security and a steady return. For someone with limited resources, the peace of mind of knowing their investment is safe during times of unpredictable world.